Welcome along. It's Wednesday, April 30th, 2025, and you're tuned in to the 29th episode of FinWell Daily Brief.
Great to be here.
Just a quick note, all the financial figures we'll be discussing are based on today's market close.
Fresh off the press.
Exactly. And speaking of fresh, let's kick things off with a really fascinating financial nugget I came across. Get this.
Okay.
In the financial year 2023, Indian households, parked a whopping 70% of their total savings in physical assets.
Wow, 70%.
Yeah. Think homes, land, gold, the tangible stuff. Now compare that. Only about 29% went into net financial savings.
So stocks, bonds, bank deposits minus debt.
Precisely. It really shines a light on where the bulk of India's household wealth resides, doesn't it?
It absolutely does.
Yep.
That high allocation to physical assets, well, it speaks volumes. It's not just numbers. It's about investment preferences, maybe even economic priorities.
What does it suggest, though? I mean, that preference.
Well, it suggests a strong inclination towards security, towards things you can see and touch. Land, gold. These have deep cultural roots, right? They represent long-term value, stability, maybe less perceived volatility than, say, the stock market for many.
That makes sense. And the flip side, that lower net financial saving, around 29%. What could be the reasons there?
Several factors, I think. Familiarity, for one. Real estate is easier to grasp, perhaps, than complex financial instruments. Access could be another historical factor, though that's changing fast.
Right.
And don't forget the emotional connection, that sense of tangible ownership. Plus, concerns about market risk definitely play a role in pushing people towards perceived safety.
Okay, so the 7-9 split.
Yeah.
How does it influence the bigger picture, like overall economic growth, the capital markets?
It's a really key question. When so much savings is tied up in physical assets, it means potentially less capital flowing directly into financial markets, stocks, bonds.
Which could make it harder for businesses to raise funds.
Potentially, yes. It could impact market depth and maybe make capital slightly more expensive for companies looking to expand or innovate. But on the other hand, investment in physical assets, like housing and infrastructure, is direct economic activity too.
So it's a balancing act.
Exactly. A fascinating dynamic between different forms of capital.
It really gives you food for thought.
Okay,
let's shift gears slightly. How did the markets actually do today? Let's get a quick look.
all right, let's see.
So the Nifty 50, it closed at 24,285.40, down just a tiny bit, 0.21%. The Sensex was hovering around that 80,000 mark.
Holding steady mostly at the large cap end then?
Seems like it. But look at the midcap 150, closed at 19,800.15, down 1.04%. A bit more of a hit there.
Yeah, definite underperformance compared to the large caps.
And even more so for the small cap 250. Closed at 15,304.35, down a significant 2.14%.
Oof. Yeah, that's quite a drop. Small caps really felt the pressure today. Maybe some profit taking or perhaps more sensitivity to those geopolitical jitters we keep hearing about.
Could be. The Nifty Total Market Index, sort of the overall picture, closed at 12,320.15, down 0.79%.
So broader market showing weakness led by the smaller segments.
Right. And what about bonds? The 10-year GSEC yield?
Sitting around 6.4%. And interestingly, the RBI has been active, injecting liquidity recently.
Trying to keep those yields in check, I suppose.
Seems likely. It's about managing borrowing costs and ensuring stability in that crucial government bond market.
Makes sense. And the currency, USD/INR.
Closed at 84.49. But there was some drama earlier, wasn't there?
Yeah. It weakened quite a bit, hit around 85.15 earlier in the day. That's the weakest it's been all year.
Wow. That dip likely reflects those India-Pakistan tensions bubbling up again.
But it recovered, back to 84.49.
Yes, probably helped by import-related inflows, maybe oil payments coming in, providing some dollar supply. It's always a push and pull.
Fascinating how it all connects. Okay, market snapshot done. Let's dive into some of the key stories driving things today.
Let's do it. Where should we start? Inflation.
Yeah, inflation and the RBI. That seems central. The March CPI number looked pretty good, right?
Very good, actually. It eased to 3.34%. That's the lowest reading since, August 2019? It's a long time.
Prices. That's always the big one for households.
Big moderation there, too, around 2.69%. That's really encouraging news on the inflation front.
And this easing inflation, it gives the RBI some breathing room, doesn't it?
Absolutely. It paved the way for that 25 basis point repo rate cut back in April, bringing it down to 6.0%.
Oh, yeah, I remember that.
And they're projecting decent GDP growth, too, 6.5% for FY26. So lower inflation provides scope, maybe for further cuts down the line if needed. They're keeping that accommodative stance. cautiously.
Makes sense. Lower rates could be a real shot in the arm for the economy.
Okay, switching gears to equities and corporate news. Overall market was a bit subdued. Geopolitical jitters, maybe.
That seems to be the general feeling, yes. A bit of caution prevailing. But there were definitely some individual stock stories making waves.
Like Reliance, I heard they had strong results. They did. RIL beat Q4 profit estimates. The stock jumped, 5.3% earlier in the week? Hit a 6-month high? That definitely helped prop up the Nifty.
Nice boost. But not everyone shared the good fortune. What about Bajaj Finance?
Yeah, contrasting story there. Their shares actually fell 5.4%, even though they also reported higher Q4 profit.
Wait, higher profit but the stock falls? Why?
Analyst concerns. Seems they're worried about pressure on margins and potentially rising credit costs, bad loans. So the market looked past the headline profit number to potential future headwinds.
Interesting. Shows you need to look under the hood.
And HDFC Bank, they reported steady earnings. So overall, kind of mixed signals for the big names, which probably contributed to the muted overall market movement today.
Got it. Okay, let's pivot to commodities and currency. Gold's been on a tear, hitting record highs in April. What's driving that?
It's fascinating. Jewelry demand is actually down, apparently at decade lows.
Really? This is not wedding season demand?
Doesn't look like it. The surge seems to be coming from investment demand, especially into gold ETFs. People are turning to gold as a safe haven.
Because of?
Geopolitical risks, trade tensions, the usual suspects when uncertainty rises. Investors seek perceived safety. That World Gold Council chart mentioned shows investment demand at a 10-year high. It's classic risk aversion behavior.
So less bling, more buffer. Makes sense. And crude oil. Been volatile, too.
It's eased off a bit recently. Brent futures fell to around $63.05 a barrel. Seems the easing of Middle East tensions took some heat out of the market.
Okay. And we touched on the rupee's roller coaster ride. Recovering due to import flows, you said.
Yes, things like oil import payments bring dollars into the system, which helps support the rupee against the dollar, counteracting some of the pressure from, say, geopolitical worries.
Always a balancing act. Right, let's check in on the tech and startup world. Always buzzing. An IPO filing.
Yes, Urban Company. The home services app, backed by Tiger Global. They filed draft papers for quite a large IPO.
How large?
Aiming for about $19.0 billion, which is roughly $223 million. It's a mix of new shares, about $4.29 billion, and an offer for sale from existing investors of $14.7 billion.
That's a significant listing. But the report mentions market volatility, referencing Ather Energy scaling back its IPO plans. Is it a tricky time to list?
It can be. It certainly suggests that while appetite for good companies exists, investors are likely being more selective, scrutinizing valuations very carefully in the current environment. You need a solid story and sensible pricing.
So what's Urban Company planning to do with the funds raised from the new shares?
The usual for a growing tech platform, really. Investing in their tech, expanding operations, basically scaling up their presence and service offerings. Standard growth playbook.
And this seems part of a bigger trend, right? More unicorns heading for the public markets in 2025.
Absolutely. The report mentions PhonePe, maybe a Flipkart affiliate, some ed tech leaders. It really feels like 2025 could be a landmark year for Indian tech IPOs.
Okay.
Shows the maturity of the ecosystem.
Very exciting times for the startup scene. Okay, before we unpack what all this means for you, our listener, we have a quick message that might be really interesting.
How's good?
Now, are you a Gujarati NRI? Have you been thinking about investing back home, specifically in the booming real estate market in India? Well, listen up.
This sounds targeted.
It absolutely is. You need to check out the latest bonus episode from the Ahmedabad Real Estate Podcast. It's produced by the fantastic team at Audiocast Lab.
Okay.
This isn't just any episode. They're calling it a game changer for Gujarati NRIs investing in India. It's laser focused on the huge opportunities in Indian real estate right now, especially for the Gujarati diaspora.
What kind of insights can listeners expect?
Oh, amazing stuff. You'll hear directly from developers on the ground in Gujarat about the latest projects and hotspots. Plus, financial experts are breaking down NRI-friendly financing options, making it easier to invest from abroad. They even cover the legal stuff you need to know.
That sounds incredibly practical.
Totally. And they explain why experts are calling 2025 the year of opportunity. Think policy changes, massive infrastructure boosts. It's all creating fertile ground for growth. Seriously, if you're a Gujarati living abroad and want to grow your wealth back home through property, this is a must listen.
Actionable insights, case studies. Sounds very valuable.
It really does. You get actionable tips, real-life examples, everything you need to make smart decisions. So just search for the Ahmedabad Real Estate Podcast wherever you listen. Don't miss it.
Great recommendations. A very useful resource for that specific audience.
Definitely. Right. Let's flip back to the bigger market picture, trying to pull all these threads together. What does it all mean for you listening right now? The overall macro backdrop for India still seems quite favorable, doesn't it?
It does, yes. That slowing inflation we talked about, plus the solid 6.5% GDP growth forecast, that provides a pretty strong cushion for the markets. A resilient domestic economy is key.
And the RBI's actions, lower rates, plenty of liquidity, how might that play out across different sectors?
Well, you'd expect banks and financials to benefit, right? Lower rates can spur lending activity. And sectors like real estate and infrastructure, which are quite sensitive to interest costs, could see renewed interest and maybe some fresh investment flows.
Okay. And India's external position, services exports, remittances, the rupee stability.
Still looking quite robust. Strong services exports and those steady remittance inflows really help support our current account and provide relative stability for the rupee, even with occasional shocks like we saw earlier today.
Given all the global uncertainty, though, are there specific sectors that look maybe more attractive or, let's say, defensive right now?
Well, in times of volatility, investors often favor defensive plays. Think consumer staples, things people buy regardless of the economy. Pharma is another classic defensive sector. And as we discussed, gold, given its safe haven appeal.
Right. And what about those midcaps that took a hit today? Any potential for them to bounce back?
Oh, absolutely. Today's underperformance could just be a blip. If global trade worries ease up, or if market sentiment generally improves, midcaps, often more domestically focused, could certainly attract renewed buying interest. They've had a good run prior to this.
So putting it all together for our listeners, thinking about their own investments, what's a sensible approach in this environment?
Look, maintaining discipline is key. Diversified equity exposure, maybe through SIPs to average out costs and navigate volatility, still makes a lot of sense for the long term.
And maybe not putting all eggs in the equity basket.
Exactly. Having some allocation to fixed income provides that important cushion and helps balance the portfolio, especially when markets feel a bit choppy. Prudence is always valuable.
And what will the pros be watching closely in the coming weeks?
Definitely next month's RBI data for more clues on inflation growth. And of course, everyone keeps an eye on the U.S. Fed. Any signals from them about future policy moves always ripple through global markets, including ours.
So overall, the feeling is cautiously optimistic, based on strong earnings, domestic demand.
I think that captures it well. Cautiously optimistic. The underlying fundamentals in India look solid, but you can't ignore the global headwinds.
Right. So, to wrap things up for today, the market finished modestly lower. Caution seemed to be the word, driven by those global and regional risks.
Yep, a bit wait and see, perhaps.
Key takeaways: India's inflation is looking benign, which is good news. Further RBI easing seems possible down the road. Equities might face some bumps in the short term, but those long-term domestic growth drivers, they still look strong.
Agreed. The core story remains intact.
And hey, if you found this briefing valuable, and we hope you did, please make sure you subscribe. Get your daily dose of financial insights right here.
Definitely. Stay informed.
And do connect with SOS FinWell over on LinkedIn. It's a great place to continue the conversation, ask questions, and explore more perspectives.
Good shout. Engagement is key.
Finally, let's end with this thought, often quoted in financial circles. A steady rupee and rising savings give strength to markets. Patience and prudence pay off.
Wise words indeed.
Keep that in mind as you prepare for your investments. We'll be back with another FinWell Daily Brief